Happy Monday, investors. Welcome to the channel where I use technical analysis to find possible swing trades. Before beginning, I'd like to make it clear I'm not a financial advisor. Everything I say is for informational, educational, and entertainment purposes. Technical indicators like those I use here are not accurate 100% of the time, and company fundamentals and macroeconomic factors can drive share price changes differently than what we might expect based on technical indicators. My goal is to bring these companies to your attention so you can decide for yourself whether or not they're good investments for you. So please, if you plan on investing, do your own due diligence before purchasing shares in any company, or consult with a financial advisor. Today, we're taking a look at Dollar General Corp, ticker symbol DG. This is a US-based company well known for what they call dollar stores, which provides very low-cost goods. And looking through the list of goods available through Dollar General, it is staggering. They have a huge array of products available. This is actually larger than I expected. Its market cap is just over 33 billion. I did not realize it was that big a company, but they have apparently quite a few locations. There are several near me. So I have been to these stores and shopped there, and I've found some good deals there. I suspect that if there is a coming recession, if you believe there's still a downturn in the market, that stores like this will do well when money gets tight for the average consumer. Here we are on the annual chart, and you should immediately see why I'm taking a look at Dollar General as a possible swing trade buy. They had earnings on June 1st. I'll scroll up just a bit so you can see the whole thing. And it was an earnings miss of about 4 cents a share, which is not very big. But of course, their guidance over the next few quarters was also reduced. I'll point out that this is the third earnings miss in a row for Dollar General. So you can see, you go way back here, you get one miss, two misses, and three misses, and the trend has been downward ever since. Of course, not nearly as big as this last one. So keep that in mind. What I'm looking for here is a reversion to the mean when the economy stabilizes. Should move back up at least closer to where it was trading. It was above 200 before earnings. Now we're down at 153. So this is a huge fall considering a 4 cents per share earnings miss. And if we scroll down, you can see the RSI is well into oversold territory and looks to have turned flat. Key stochastics are both deep oversold, and they do not look like they are turning up again quite yet. The volume chart shows, as you might expect, a gigantic spike in selling, and that selling pressure is now decreasing. We got a couple green days in there, but for the most part, it's been red since the earnings announcement. And the MACD down here shows a trough formed, quite a deep one, at least considering the trough formed in the past year. And that trough looks to now be heading back towards zero. Now, as I like to do, I'm going to switch over to E-Trade and take a look at the company's financials. And there's something interesting here. We're going to start off with debt to equity. And since this is a retailer, you might imagine that it has a significant amount of debt. These numbers don't look too large to me, just as again, a cursory 10,000 foot view look down. But for the industry, this is above average. It puts it in the 61st percentile regarding debt. The PE ratio, on the other hand, is basically the mirror image. It's low, below average, less than 60% of other companies in the discount stores industry. And really, PE below 15, that seems fair. Now, the gross margin is average for the industry, but the operating margin is excellent. It beats out 79% of its peers. Now, I'll point out the operating margin is still only 8.65%. So this whole industry operates on narrow margins. Now, return on equity, again, excellent here, beating 92% of companies in the industry. That's quite an impressive number. And the growth rate is almost as impressive, growing faster than 85% of other companies. So between its operating margin and return on equity and growth rate, we're getting a picture of a good quality company that is, according to the PE ratio, a bit cheap right now. And if we go down and look at the dividend yield, you'll see that it is below average for the industry, but still above the market standard at 1.51%. The payout ratio is just below 21%. So that is a very, very secure dividend. Now, one thing I did skip, you may have noticed up here, which I think requires a little bit of consideration, is the institutional ownership at 90%, almost 91%. But look at this short interest, 35% short interest. If you have a company at 35% short interest and 90% institutional ownership, yeah, this is ripe for a short squeeze. So not only do we have a fair company with apparently decent metrics, it's just going through, looks like it's just going through a rough patch to me, anyhow, right now. But you also have the potential of a short squeeze when these shorts start to get covered by the institutions. So all that said, I think Dollar General might be in the position for a purchase now and waiting for it to swing back higher. So please let me know what you think of all that in the comments below. And if you got something out of this video, I would really appreciate it. If you'd hit the like button and subscribe to help out the channel, it really does help. If you enjoy these brief overviews of companies that might be good swing trades, please leave a comment and do all the things to help the YouTube algorithm. Or again, if you like to just tell me what I got wrong, what I missed, I welcome such criticism. Please leave those comments below as well. And if you'd like me to take a look at a particular company using these indicators, you can mention that and I'll get to it as soon as I can. That's all for today. Thanks for watching and good luck with all your investments.